Get ready to dive into the world of life and health insurance with exciting, beginner-friendly training that will give you the knowledge and confidence to succeed as a future agent. This course is designed as a supplementary educational tool to help future agents better understand and absorb materials covered by qualified trainers in preparation for the California Life Health Insurance Licensing exam. This is not intended to substitute the required 52-hour pre-licensing course mandated by the California Department of Insurance. All participants must complete the official 52-hour course from a certified provider to meet the licensing requirements. This supplementary course serves only as an additional resource to reinforce learning and comprehension of the key topics in life and health insurance.
Session 2. Life Insurance. Chapter 4. Life Insurance and Annuities. Policy Replacement, Cancellation. Slide 1. What is policy replacement? Master these terms. Policy replacement, the process of substituting an existing life insurance or annuity policy with a new one. Risks may result in higher premiums, loss of cash value, or new contestability period. Description. Policy replacement occurs when a client decides to switch from their existing life insurance or annuity policy to a new one. While this might seem appealing, especially if the new policy offers better terms, there are risks involved. The client could face higher premiums, lose accumulated cash value, or restart the contestability period, which could delay or deny claims. As an agent, it's important to ensure that the replacement is in the client's best interest and to clearly explain both the benefits and potential drawbacks of replacing their current policy. Slide 2. Reasons for replacing a policy. Master these terms. Reasons for replacement. Outdated coverage. Lower premiums with new policy. Improved benefits, e.g., riders. Switching from term to permanent insurance. Description. There are several reasons why a client might consider replacing their life insurance or annuity policy. They may feel that their existing coverage is outdated or insufficient, or they might find that a new policy offers lower premiums or better benefits, such as additional riders for enhanced protection. Some clients also switch from term life to permanent life insurance as their financial situation improves or their need for lifelong coverage increases. However, it's essential to carefully evaluate whether the new policy truly offers better value and meets the client's long-term goals. Slide 3. Risks of policy replacement. Master these terms. Key risks: loss of existing policy benefits, new contestability and suicide periods, higher premiums for older clients, surrender charges for annuities. Description. While replacing a policy can seem advantageous, it's important to consider the risks. Clients might lose valuable benefits from their existing policy, such as lower premiums or accrued cash value. Additionally, replacing a life insurance policy restarts the contestability period, during which the insurer can challenge claims or even deny them if there were misstatements on the application. The suicide clause is also reset, meaning death by suicide within the first 2 years of the new policy might not be covered. For annuities, clients may face surrender charges if they cancel their existing contract early. These risks should be weighed carefully before proceeding with a replacement. Slide 4. The replacement process. Master these terms. Disclosure requirements. Agents must provide clients with a written comparison of the new and existing policy. Regulations. Replacement is regulated by state insurance departments to protect consumers. Description. The process of replacing a policy is highly regulated to ensure that clients are protected. As an agent, you're required to provide a detailed written comparison of the new and existing policies, outlining any differences in premiums, coverage, benefits, and potential risks. This transparency allows clients to make an informed decision about whether to proceed with the replacement. State insurance departments closely monitor replacements to prevent churning, where policies are unnecessarily replaced for the benefit of agents rather than clients. By following the regulations, you help ensure that replacements are only made when it's in the client's best interest. Slide 5. Policy cancellation. Master these terms. Policy cancellation. Ending a life insurance or annuity contract before its maturity or death benefit is paid. Types of cancellation. Voluntary cancellation by the policyholder versus involuntary cancellation by the insurer. Description. Policy cancellation occurs when a life insurance or annuity contract is terminated before the death benefit or maturity is reached. There are two types of cancellation: voluntary and involuntary. Voluntary cancellation happens when the policyholder decides to end the policy, usually because they no longer need coverage or can't afford the premiums. Involuntary cancellation occurs when the insurer cancels the policy, often due to non-payment of premiums. It's important to help clients understand the consequences of canceling a policy, especially if they are giving up valuable protection or incurring surrender charges on an annuity. Slide 6. Surrendering a life insurance policy. Master these terms. Surrendering. Voluntarily cancelling a life insurance policy in exchange for the cash surrender value, if applicable. Surrender charges. Fees deducted from the cash value for early termination. Description. Surrendering a life insurance policy means voluntarily cancelling the policy before the death benefit is paid. For permanent life insurance policies, the policyholder receives the cash surrender value, which is the accumulated cash value minus any surrender charges or outstanding loans. These charges are typically imposed if the policy is cancelled within the first few years. While surrendering a policy may seem like a quick way to access cash, it comes with significant downsides, including losing the death benefit and paying surrender fees. As agents, you should help clients explore alternatives to surrendering, such as reducing coverage or borrowing against the cash value. Slide 7. Surrendering an annuity. Master these terms: annuity surrender, cancelling an annuity contract and receiving the accumulated cash value. Surrender period, the time frame during which surrender charges apply. Description. Surrendering an annuity means cancelling the contract and receiving the accumulated cash value. However, many annuities have a surrender period, typically lasting 5 to 10 years, during which surrender charges apply. These charges can significantly reduce the amount the policyholder receives if they withdraw funds early. Additionally, surrendering an annuity may result in tax penalties if the policyholder is under age 59-12. It's important to explain to clients that while annuities provide flexibility, surrendering them prematurely can be costly. Encouraging clients to understand the full surrender terms will help them make informed decisions about whether to cancel or continue their contract. Slide 8. Free look period. Master these terms. Free look period, a time frame, typically 10 to 30 days, during which the policyholder can cancel the policy without penalty. Purpose: allows the client to review the policy and reconsider the purchase. Description. All life insurance and annuity contracts come with a free look period, usually lasting between 10 and 30 days. During this time, the policyholder can cancel the policy for any reason and receive a full refund of premiums paid. The free look period gives clients the opportunity to thoroughly review their policy and ensure it meets their needs. If they decide the policy isn't right for them, they can cancel without incurring any penalties. This period is a valuable consumer protection feature that helps clients feel more confident in their purchase decision. As agents, it's important to remind clients of this option and encourage them to carefully review their policy during this time. Slide 9. Grace period for premium payments. Master these terms. Grace period, a time frame, usually 30 days, after the premium due date during which the policy remains in force. Purpose: prevents immediate cancellation for missed payments. Description: life insurance policies include a grace period, typically 30 days, after the premium due date. During this time, the policy remains in force and the insured is still covered, even if the premium payment is late. The grace period prevents policies from being immediately cancelled due to a missed payment, giving the policyholder time to catch up without losing coverage. However, if the premium isn't paid by the end of the grace period, the policy may lapse or be cancelled. As an agent, it's important to explain the grace period to clients and encourage them to make timely payments to avoid losing their valuable protection. Slide 10. Reinstating a lapsed policy. Master these terms. Reinstatement: restoring a lapsed life insurance policy by paying overdue premiums and meeting certain conditions. Conditions: typically requires proof of insurability and payment of back premiums with interest. Description: if a life insurance policy lapses due to non-payment of premiums, the policyholder may have the option to reinstate the policy. Reinstatement allows the policy to be restored to its original terms, but there are certain conditions that must be met. The policyholder will need to pay all overdue premiums, often with interest, and may be required to provide proof of insurability to show that they are still in good health. Reinstating a policy can be a good alternative to purchasing a new one, especially if the original policy offers better coverage or lower premiums. As agents, you can guide clients through the reinstatement process and help them evaluate whether it's the right choice for their situation. This completes Chapter 4, Life Insurance and Annuities, Policy Replacement Cancellation of Session 2, Life Insurance. Coming next, Session 2, Life Insurance. Chapter 5, the Individual Life Insurance Contract.
Great job. Great job completing this session. You're building a strong foundation, and the next chapter will take you even deeper into the essential skills you need to master. Let's keep momentum going, jump into the next session, and continue your journey to becoming a top-notch life and health insurance agent.